Attention, people who still care. What simple steps can us regular people take to fix our broken financial system? This is the question we ask on the Crown Effect podcast. I am your host, Paul Lovejoy, activist investment advisor at Stakeholder Enterprise. On today's show, bottom-feeding lender Snap Finance is sued by the Consumer Financial Protection Bureau for illegally hiding their lending terms and services on their financial agreements. Rumor has it that an affected customer hid his boot up Snap Finance's CEO's. I think you get the picture. But before we talk about Snap Finance, I first want to tell you Angela's story. Now, Angela had big dreams and aspirations, but life hadn't been kind to her. Struggling to make ends meet, Angela often found herself drowning in financial woes. One day, while she was walking through the city's furniture district, she came across a flashy store with a sign that read, "Instant approval, no credit check needed, affordable lease purchase plans." Intrigued, Angela stepped inside, hoping she could find a solution to her being able to afford a new sofa. The store was partnered with Snap Finance, a consumer finance company that offered lease purchase agreements to consumers like Angela. The store clerk enthusiastically explained how the financing worked, highlighting the ease and convenience of the process. Lured by the promise of obtaining a new sofa without a credit check, Angela decided to give it a shot. The store clerk handed her a tablet with a digital agreement. As Angela tried to read through the lengthy document, the clerk assured her that it was all standard information. However, the tablet's user interface was complicated, and the terms and conditions seemed obscured, making it difficult for Angela to fully understand the deal. The clerk, in a rush to complete the sale, urged her to sign, mentioning that the terms were fair and straightforward. Angela hesitated, but the pressure and excitement of finally getting a sofa overwhelmed her better judgment. Moreover, the tablet system required her to pay a fee before revealing the full terms of the agreement. Desperate to improve her situation, she reluctantly agreed to the terms without fully comprehending the extent of her payment obligations. Weeks turned into months, and Angela diligently made her payments, believing she was on the path to owning her new sofa. However, as time passed, she noticed the amount she owed wasn't decreasing as much as she expected. Realizing she was trapped in a cycle of payments with almost no end in sight, Angela decided to investigate further. Researching online, she discovered that Snap Finance has a history of deceptive practices and had been accused of obscuring the terms and conditions of their financing agreements to exploit vulnerable consumers. The truth hit her like a tidal wave, and she felt betrayed by the very company she hoped that would help her out of her low credit score situation. Now, Angela is a fictional character, but the consequences of Snap Finance's obscuring their terms and services are very real, which brings us to our news story. The Consumer Financial Protection Bureau is suing Snap Finance for deceptive and abusive practices. Now, the CFPB sued Snap Finance yesterday, which is a lease-to-own finance company, for deceiving consumers, obscuring the terms of its financing agreements, and making false threats. The CFPB alleges that Snap Finance has offered and provided millions of lease purchase and rental purchase financing agreements in ways that have harmed consumers, including through misleading advertisement. Snap Financing's advertisements often misled consumers about the true cost of the financing, making it appear as though the payments were lower than they actually were. Insufficient disclosures. Snap Finance failed to provide consumers with important disclosures about the terms of its financing agreements, such as the length of the agreement, the total amount of payments, and the interest rate. Interference with consumers' ability to understand the terms of agreements. Snap Finance made it difficult for consumers to understand the terms of its financing agreements by using complex language and burying important information in the fine print. Bullying and harassing of borrowers. Snap Finance has a history of bullying and harassing borrowers who fall behind on their payments. The company has threatened to repossess consumers' belongings, damage their credit, and even sue them. Snap Finance illegally obscured terms and conditions of their so-called rental purchase agreements, which led to exorbitant charges, said CFPB Director Rohit Chopra. To ensure fair competition and to protect the public, the CFPB is carefully watching lending outfits operating outside of the traditional banking system. The CFPB alleges that Snap Finance's practices violated the Consumer Financial Protection Act, the Truth in Lending Act, the Electronic Fund Transfer Act, and the Fair Credit Reporting Act. A class act, Snap Finance is not. The CFPB's lawsuit seeks to stop Snap Finance from continuing these deceptive and abusive practices, as well as to obtain restitution for harmed consumers. This is not the first time that Snap Finance has been accused of wrongdoing. In 2020, the company was sued by a class of consumers who alleged that it had engaged in deceptive and abusive practices. The lawsuit was settled for $12 million. Now, I'm going to be following this story, and I'm going to see what the CFPB does and what Snap Finance does. Now, this doesn't surprise me, this story about Snap Finance, because the financial services industry is the most abusive industry that operates in the United States today by a long shot. Now, according to the Violation Tracker Project, which has been tracking corporate penalties in the United States since the year 2000, well, they have found that the financial service industry has racked up a total of $377 billion in fines since the year 2000. All right, let's put that number in perspective. Okay, so financial service industry at the top of the list. All right, in second place is the pharmaceutical industry with $114 billion in fines since the year 2000. In third place, we have oil and gas at $55 billion. Okay, so it doesn't take a mathematician to figure out that the second and third place industries combining their penalties doesn't reach the $377 billion that the financial services industry has. In fact, if you take the second place industry of pharmaceuticals and the 10th place industry, and you add up all of their penalties combined, it totals $362 billion in fines and penalties. That still doesn't add up to the financial services industry at $377 billion. So this industry is abusing the public over and over again, and will continue to abuse the public. And it's not like this industry hasn't been fined and penalized. Obviously they have $377 billion worth of penalties, and nothing seems to change. So why is this? Why is the financial service industry repeatedly getting fined and penalized And it keeps happening. These stories just are constantly coming out. Well, it's because of the way corporations are designed. Now, many of us have thought about corporate bottom line and how that affects our economy and how that affects the working class and how it affects everything. And especially these corporations that are public. Now, Snap Finance, it wasn't public, but it was designed to be a bottom feeder. Their whole business model is around lease to purchase financing, which is, in a sense, they're targeting people who can't afford things like appliances and sofas with a credit card. They can't. They don't have the credit score to be able to pay for a sofa with a credit card. So this is a very vulnerable group of people, and it's a large group as well. And so the Snap Finance was designed to target this segment of the population that isn't really have done well with their finances. And I'm not blaming a segment of the population. Financial literacy, that's not taught in our schools. So many people are ignorant with financial literacy. Very educated people, you could talk about doctors and lawyers and engineers and professors. These people, they're not taught financial literacy either. So the sad thing is that the people who are using these lease to own financing agreements, well, they don't make as much as an engineer or a physician. So it affects them in a much different way. So it's the way that the corporations are designed that is the root issue here going on. So how can we change that? What simple steps can us regular people take to fix this broken financial system? Well, there are a couple of things. First off, if you're looking to get financing, the best way to do it, from my point of view, is through a personal line of credit. Now, personal lines of credit most credit unions offer them. Now, credit unions, they're designed differently than commercial banks. They're nonprofit, so there's no incentive for them to be unethical to increase their profits because they're nonprofit. Snap Finance, they have incentive to be unethical in order to increase their profits. And the financial services industry, there's a lot of companies out there. So in order to make a profit, many companies feel like they have to engage in these unethical behaviors. Okay, so the big banks, which are part of the financial services industry. Let's take Bank of America, who was just recently penalized $250 million for a number of reasons. One of them was double dipping fees, specifically their overdraft fees. So people were using their debit card, and it triggered an over the limit fee, which the debit card charged a fee for overdraft, and then their bank account charged another overdraft fee. So it got double dipped. Now, here's the thing. Bank of America, they don't offer lines of credit. Personal lines of credit. You can't get one from Bank of America, but most credit unions do. And here's why this is important, because a personal line of credit can be attached to your bank account. So instead of having overdraft fees, the personal line of credit will kick in when it provides this overdraft protection. Okay, so a personal line of credit. What is that exactly? Well, it's revolving credit, just like a credit card. You don't have to pay anything unless you actually use it. And if you pay it back before the end of the month, there is no interest rate that is charged. So, line of credit. Here's another thing. A personal credit card, just a regular credit card, according to Wallet Hub, the average credit card interest rate is 22 and 0.45% for new offers and 20.68 for existing accounts as of July 2023. Okay, let's compare that to a personal line of credit, which essentially is the same thing. It's just this revolving debt. And one is attached to a credit card. The other one's attached to your bank account, which in a way is attached to your debit card. So according to financestrategist.com, the average interest rate for a personal line of credit ranges from 8 to 10%. That's less than half the interest rate. So if you belong to a credit union, if you don't, that's a simple step to take. Take your money out of the big abusive banks and put it into a local credit union where you can get a line of credit and attach it to your bank account. And now be able to purchase that sofa that you want with this line of credit instead of a shady rent-to-own deal. Now, rent-to-own may have some advantages because you can actually give it back, the product, without fully paying for all of it. And Snap Finance was making it difficult for consumers to do just that. They're hiding it. And I'll talk about that more later. But if you want to actually finance something, that's the way to go with a line of credit. It's also simple interest. Every time you pay it down, you're only paying on what you borrow. So that's step number one. Get a personal line of credit in a credit union. You're not going to face these overdraft fees, and you don't have to deal with these bottom feeding lenders like Snap Finance. All right, that's number one. Number two, there is in the world of crowd investing, there is something called equity crowdfunding, and this is when a large group of people, regular people, you and me, pool small amounts of money to fund startup companies. So why is this important? Well, startup companies, this is where companies are designed at the very beginning when you're a startup. And now, regular people, you and me, we can design companies, finance companies that are ethical. Maybe if a lease to purchase financing agreement was done ethically and done in a way that was transparent, and it's not trying to soak up as much profit for a few greedy owners. When it's a crowdfunded, now you have lots of regular people as owners, and you want to talk about regular people. Say, hey, I'm a part owner of this finance company, and we're transparent. It just allows for an avenue for good companies to be able to be produced. And it's not a few wealthy people that are going to profit from its success. It's regular people. So it's a way to erode the wealth and power of these institutional investors, these large corporations, these wealthy big banks who have historically just dominated the startup industry in designing companies, providing funding for these companies. So those are two simple steps. With equity crowdfunding, there are platforms with as little as $100 to invest in a startup company. And there is a platform where you can auto invest in startup companies for as little as $50. That's as easy as it gets. These are just two simple steps that we can all take to be the change without arguing, without a divisive political action that has the potential to actually be profitable, to increase the value, the worth, the financial worth of regular people. My name is Paul Lovejoy. I am a crowd investor, and I see you are one too. If you'd like to know the 3 secret steps to fix our broken financial system, legally, democratically, and without divisive confrontation, go to stakeholderenterprise.com.